This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Saving face. Facebook surprises Wall Street with a strong quarter, and investors are hitting the like button. But with the stock still well below its IPO price, is there any reason to buy?
Tour, a.k.a. Fabulous Fab, takes the stand. The former Goldman Sachs trader who has become the symbol for Wall Street greed during the financial crisis breaks his silence in court.
And a new retirement playbook. With interest rates near historic lows, safe investments are delivering lousy returns. So tonight, find out if alternative strategies are right for you as we continue our series, How to Not Outlive Your Money. We have all that and more on Nightly Business Report for Wednesday, July 24th.
Good evening, everyone, and welcome. Earnings jump, revenues spike, and Facebook investors are friending the stock late in the day, sending it up almost 20%. The social networking company reported a profit of 19 cents a share, excluding accounting charges. That easily beat expectations of 14 cents. Revenues up 53% over last year, and the closely watched mobile slice of its business boomed. Kayla Tausche here now with a deeper look at what's driving the numbers. Kayla?
Tyler, what's driving Facebook's popularity this quarter was once its biggest worry. That's your mobile device. A year ago when Facebook went public, it warned it didn't know how much money it could make off mobile advertising, even as its users went mobile in droves. This quarter was affirmation whatever they're doing is working. Mobile revenue was zero this time last year. Now it's 41% of Facebook's $1.81 billion in revenue. It's true more and more people are using their phones to Facebook. In the second quarter, 819 million active users were on the site. That's up 51%. CEO Mark Zuckerberg said on the company's conference call, quote, "Soon we'll have more revenues on mobile than on desktop. Whatever the platform, advertisers like Facebook and find their ads to be effective. More than 1 million companies currently take out ads on the social network. The biggest growth there is for small and local businesses.
1 million companies have ads.
1 million companies are advertising on the network. You would never think that. 1 million companies.
Stunning. Kayla Tausche, thanks very much.
Well, our next guest says this is a breakout quarter for Facebook. He's David Garrity, a principal at GVA Research. So, David, how do you feel about Facebook tonight? Is this a stock that you would buy, sell, or hold?
I think if the stock stays up 20% as it is as we go into the market tomorrow, target price I'd have for Facebook out 12 months is about $35 a share. The stock's trading at 31. Certainly it would continue to be attractive, but I think that there's some other names that might be even more so.
How surprised were you, David, at the numbers they posted today?
Very positively surprised. The biggest surprise was the percentage of advertising revenue that was coming from mobile. Expectations had been it would be about 33%, and to have it come in at 41% certainly shows a very significant adoption over the last 3 months. Obviously, we'd have to be concerned as to what extent we see that number moving higher than 50%, and what does that mean in terms of the company getting less per ad than they would traditionally off of their desktop product.
All right, so it looks like things were working in this quarter. What does Mark Zuckerberg and the company have to do now?
Well, what the company has to do is to, one, I mean, they've spent a lot of money in terms of buying this company, Instagram, which they paid about $1 billion for, and is a company that didn't have any revenue. Clearly, they have to show shareholders that they can successfully monetize this billion-dollar investment in this company. How they plan to do that clearly is a very open question, and something I think that investors are going to want to hear more about from management, not just in terms of today's conference call, but going forward.
If I were to sort of surmise from what you said a moment ago, you like Facebook, you don't love it. There are other companies that you like more and maybe love. Why is that? What is holding you back on Facebook? And what makes you like some of the others more?
Overall, first and foremost, looking at the valuation. I mean, we've had a very nice acceleration here in terms of this revenue growth. We are seeing some of that pass through to the bottom line. Arguably, EPS, though, isn't growing at the same rate year over year that revenues are. But the valuation on the stock is still fairly stretched. If we look at some other large technology-oriented names, whether it's an Apple or a Google, growth rates aren't too much less than they are Facebook, but the multiples are much less demanding.
David, I know you're bullish on Apple. If you had to choose one, Apple or Facebook, which would it be?
I would take Apple over the next 6 months.
But Apple's profits were down year over year yesterday, David, so it really isn't growing, is it?
Well, what we're looking at now is going into the second half of the year. You're going into a period of time where Apple's going to be introducing new products. Margins are going to expand. Obviously, prior year comparisons are going to be easier, so you're going to see a return in terms of profit growth. The other advantage you're getting in terms of Apple is just, much less demanding valuation. Also, at the same time, with respect to Apple, you're also getting a not insignificant dividend, whereas you don't get that with Facebook.
Okay, great stuff, David, as always. Thank you so much. David Garrity of GVA Research.
And on Wall Street today, the Dow and the S&P pulling back from record highs, dragged down by weak earnings results from the Dow component Caterpillar and AT&T after the bill yesterday. But a strong performance from Apple as they exceeded expectations kept NASDAQ in the black, but just barely. The Dow shedding 25.5 points to close at 15,542. The NASDAQ added a fraction of a point, 35.79 the close there. The S&P 500 fell nearly 6.5 to 1685.
President Obama focused in on the economy and jobs today. Speaking in Galesville, Illinois, he defended his administration's policies, criticized Wall Street irresponsibility, Washington policies, and emphasized the need to grow the middle class.
This growing inequality, not just of result, inequality of opportunity. This growing inequality, it's not just morally wrong, it's bad economics. Because when middle-class families have less to spend, guess what? Businesses have fewer consumers. When wealth concentrates at the very top, it can inflate unstable bubbles that threaten the economy.
This is the first in a series of economic speeches the president will be making about his vision for the economy and leading up to what some expect will be a major political showdown over the debt ceiling debate this fall. And Republicans are paying attention.
Because Americans aren't asking the question, where are the speeches? They're asking, where are the jobs?
Well, one area of the economy that has been helping create jobs is housing. And a new report suggests the pace of the housing recovery is strong. Sales of newly built homes rose 8.3% last month. That's the fastest rate in 5 years. And for the first time in 2.5 months, the rate on a 30-year fixed-rate mortgage fell, averaging 4.58%, that according to the Mortgage Bankers Association. But last week's rate decline, however modest, did not boost demand for mortgages as applications fell.
For all those troubled homeowners who received help through the government's foreclosure prevention program, many are defaulting again. A report from the program's watchdog says 46% of homeowners who received loan modifications are unable to make their current payments. The program was launched back in 2009 in response to the housing crisis.
A mortgage investment is at the center of a closely watched fraud trial of a former Goldman Sachs trader. You may not know the name, but to many, Fabrice Tour has become the symbol of Wall Street greed that defined the financial crisis. Tour is accused of misleading investors and secretly helping hedge fund manager John Paulson construct the mortgage security he could then bet against. It's the highest profile trial to come out of the financial crisis, investigations by the Security and Exchange Commission. The civil case is also getting a lot of attention because the government is basing its case on many emails sent by Tour. Back in 2007, he referred to the financial markets as the whole building is about to collapse any time now. Today, in a Manhattan courthouse, he took the stand to testify in the trial. Our Mary Thompson was inside the courtroom and joins us now. Mary, what stood out? What did Tour say?
Well, Tour was very energetic, very confident on the stand today. In fact, he was so energetic, he actually at one point knocked off a container of water from the stand. It was covered, so nothing was spilled. But he was responding to the SEC, which came out swinging today, Tyler, immediately going to emails that he wrote suggesting that Paulson's hedge fund actually had a long position in the security in question, this being a synthetic CDO called Abacus. Now, Tour admitting on the stand that those emails were both inaccurate and misleading, or I should say inaccurate about Paulson's position. He said, I wasn't trying to confuse anyone. But again, the SEC pounced because, as you suggested, the SEC is trying to convince jurors that Tour deliberately misled investors that Paulson's fund had an equity or long position in the fund, something that would make them more confident when indeed Paulson actually had a short position, which allowed him to profit considerably, basically to the tune of $1 billion.
Mary, let's fast forward a little bit. What's at stake for Tour if he loses this case?
Well, again, this is a civil trial, so he won't be going to jail, but he will likely face fines and penalties if found guilty. He also could face possible bans from the securities industry. Keep in mind that Mr. Tour has left Goldman Sachs, and he's currently in a PhD program in economics at the University of Chicago.
Mary Thompson, thank you very much.
And now to another courthouse, this one in Detroit, where a judge cleared the way for the bankruptcy case to go forward without legal challenges in other courts. This was the first hearing related to the city's bankruptcy, and Scott Cohn was there. Scott?
Susie, the city of Detroit was founded 312 years ago today. And for those who believe that what this city needs is a quick and thorough restructuring, this may have been quite a birthday present. At least that's what U.S. bankruptcy judge Stephen Rhodes said. He believed that clearing the way for a court case in his court, doing away with other challenges in state courts, is in the public interest. A spokesperson for the bankruptcy expert appointed by the governor to oversee this restructuring says the ruling by the judge is an important first step.
This allows us to move forward. What we really can't have are weeks and weeks and weeks of delays, because that's what runs up the costs. Everyone in that room was being paid. It runs up the costs. The longer we're in court, the longer this is unresolved.
But the unions who've been pressing those challenges in the state court say their fight will go on even if it is in federal court. They say that the bankruptcy filing is actually an attempt by Republican Governor Rick Scott to do an end run around the citizens of Detroit and around a provision in the state constitution that protects employee pensions.
We've got a governor, we've got a lieutenant governor, and we've got a party that just says we don't care about folks. We care about our own agenda. Agendas is not what we're about. In America, we're about people's rights, and that's what we're fighting for.
That fight, though, now will be squarely here in federal court. Another hearing in the case is scheduled for next week.
All
Tyler?
right. Scott Cohn, thank you very much. Scott Cohn reporting live from Detroit. Well, federal authorities are reportedly preparing to bring criminal charges against SAC Capital. That's the hedge fund run by the billionaire investor Stephen Cohen. The expected charges against the company, but not against Cohen himself, could be announced as early as this week. According to the Wall Street Journal, no major financial firm has survived a criminal indictment. Cohen is already facing civil allegations from the Securities and Exchange Commission, accusing him of failing to supervise his firm properly. SAC has been the target of a multi-year insider trading investigation. And still ahead, with interest rates near historic lows, many safe retirement strategies aren't delivering. So should you look at unconventional ways to protect your retirement? Our series on how to not outlive your money continues. But first, how the international markets closed today. Another twist in the Dell saga. Founder Michael Dell increased his buyout bid for the company by 10 cents a share. Dell and his private equity partner Silver Lake call this their final and best proposal. The sweetened bid comes as Dell's board pushed back the shareholder vote to August 2nd. The vote had been scheduled for tonight.
We focus on defense stocks in our market focus tonight. Despite the sequester and the military wind down in Afghanistan, major defense firms are setting new highs. Northrop Grumman beat estimates on revenues and profits thanks to better margins, and the company raised its full-year forecast. Shares touched a new all-time high before closing at $90.30, up almost 2%. Dow component Boeing also hit a new high as its commercial plane revenue jumped 15%. Profits were up 13%. That was more than the street expected, and Boeing raised its full-year guidance. Shares dropped after that new high, down, though, less than 1% to $106.95.
And another new high, more than 2 years, for Ford Motor, reporting a 15% jump in revenues on those Ford F-150 pickups and record profits in Asia Pacific. Ford put some polish on the full-year outlook as well. Investors bought the news on double usual volume as Ford gained 2.5%. It closed at $17.37. Ford, by the way, up more than 90% in a year. Going the other way, Caterpillar dragged down the Dow as profits dropped 43% on a sharp decline in revenue. Jim Chanos, the noted short seller, told an investment conference last week that this cat may not have 9 lives.
We are short Caterpillar Inc. Iconic American company, leader in its class, but tied to the wrong products at the wrong time in the cycle.
Cat CEO Douglas Oberhelman acknowledged the headwinds as investors dropped the stock about 2.5% on more than double the normal volume. Cat closed at $83.44. And Visa's profit jumped 16% as payments and card transactions increased. The board greenlighted a new $1.5 billion share buyback, and the company affirmed guidance for the rest of the year and 2014. Shares of Visa had been down during the regular session, closing at $186.75, but they popped on the profit news after the bell.
Baby boomers and retirees are laser focused on their investments these days. One of their big worries, they will outlive their savings. With interest rates at historic lows, so-called safe investments have had dismal returns. And as Sharon Epperson reports in the third part of our series, How to Not Outlive Your Money, some investors are considering less conventional retirement strategies.
Many of my patients have been with me from the beginning.
Dr. Joel Singer has built a successful dental practice over the last 2 decades.
The beginning of the career was really just trying to get the practice going and, truthfully feed some money into the practice at the beginning. At that point, my wife and I had some Roth IRAs and different IRAs, and most of those were cashed in early on to pay the bills.
Now the 51-year-old dentist has a 401k plan for his staff and for himself, but he worries that he hasn't saved enough to fund his retirement and future financial goals.
At my age, my understanding traditionally is that people would be a little more conservative, but I feel that it's necessary to be somewhat aggressive to be able to accumulate a significant amount of money within the next 10 or 15 years.
The old way of retiring, loading up on fixed income, bonds, money market funds, CDs, isn't as effective today. With interest rates at historic lows and people living longer, if you're too conservative with your investments, your money may not last as long as you'll need it.
The answer in our view is you look to the equity markets where potentially you have much higher returns over the long term. But with equities, you have more risk. There's no doubt about that. So how do you take care of the risk?
Researcher Barry Gilman says longevity insurance is one way to reduce the risk. This type of insurance acts like an annuity that pays out a guaranteed income, but not until you've reached the age of 80 or 85.
If you put some money up at the time you retire, maybe at 55, 60, 65, but you don't take the income out as an annuity until you're much older, 80 or 85, you get a much higher annuity or pension doing it that way than if you just bought an annuity right at the time you retired.
If the stocks in your portfolio sink, this insurance will provide a steady income. But longevity insurance is not an investment. It's for investment protection. If you don't reach age 80 or 85, you won't get the money. That's another risk. But Dr. Singer believes this strategy still may be worth a shot, just to make sure he doesn't outlive his savings. For Nightly Business Report, I'm Sharon Epperson.
All right, let's turn to a financial advisor for his thoughts on this strategy and more. And he is James Shagawat, a wealth management principal at the Barron Financial Group. James, welcome. What do you think of longevity insurance? Good idea, bad idea?
It depends, really. It might be appropriate.
I was afraid you were going to say that.
That's the answer, right? Yeah. There are risks to it. You're putting down a big lump sum of money, not to collect it until you're 80 or 85.
Would you tell your mother to do it?
I probably wouldn't. I'd probably advise a more diversified strategy and not take the risk of, what if something happens? This is
What if you don't reach that 80 or 85? You collect nothing for the money you've put in.
That's right. You collect nothing.
That's the risk.
That's the risk.
So what would you tell your mother to do? What are alternatives that you can sleep at night and still have money to last you through your retirement?
I mean, that's first. We got to make sure my mother has peace of mind. So what we would do is diversify across many asset classes. So stocks are risky. Bonds are not paying a great return right now. How do you balance that to get a better return? There's alternative investments. And two that we like a lot are real estate, which are real estate investment trusts through a mutual fund. And another is natural resources, which are commodities like oil and gas and timber. What they do is they don't act the way the market does. So let's say the market's on a tear. These might not be, but if the market corrects, these might help
But they're
things
still kind of
afloat.
volatile investments. They're not exactly sleep well at night type of alternatives, right?
You're correct about that. And it's very important to keep them with bonds and stocks, never on their own. You don't want a big concentration. I mean, at our firm, maybe 25% of clients' money is in alternatives, but they do work.
So if I'm, let's say, in my mid-60s or maybe even a little older than that, and I want the kind of balance, well, here we go, a sample portfolio. You've got 25% in alternatives, 25% in international stocks and bonds, 25% in domestic stocks, and 25% in standard fixed income. So that kind of 25-25 is the mix that you would argue is a good benchmark?
That's right. That's a good mix that we would use for a client.
Now, when you say timber, timber, when you say that, you're not telling me to go out and buy forests, are you?
No. A very small sliver of your portfolio would actually be in timber.
How do I get it? How do I buy it?
Yeah.
I don't go to a lumber yard.
That's right. Through mutual funds or exchange-traded funds. They're a pool of different commodities. So, yes, they're very volatile.
And real estate, too. You're thinking REITs, the same thing?
Not direct REITs, but mutual funds, exactly. Now, this is geographically diversified. And it's not single-family homes the way you think of real estate. This is storage facilities and assisted living, and not just concentrated in one part of the country, but across the country. So we put generally about 5% of our clients in real estate. And over the last 3 years, it's been the best performing asset class.
When you say international stocks and bonds, you've got 25% in that category. Again, I am assuming you're thinking of mutual funds or ETFs that do this. Are you talking about a broad international fund, an index kind of fund, or one that concentrates in a particular region?
A combination. We do like index, we do like actively managed. But for international, we're concerned about exchange rate risk. So mutual funds are the perfect vehicle for those. Very diversified, low cost on exchange-traded funds. We've been using more of those. And it's really been working. It's helping portfolios grow, which is the goal, just like the client there. Protect the money and have it grow and make sure it's there for life.
James, I liked how you looked at the camera when you said my mother's peace of mind is critical. You were talking right to her. James Shagowat, thank you very much. He's with the Barron Financial Group.
All right, well, for more on the story, you can log on to our website, nbr.com. And tomorrow we'll continue our special series on how to not outlive your money. Our look this time is going to be on the benefits of downsizing as a way to stretch your retirement budget. Still ahead on the program, Team Starbucks or Team Dunkin'? Americans are loyal to their coffee brands, but which company is winning over caffeine cravers? But first, let's take a look at how commodities, treasuries, and currencies performed today. A natural gas rig continues to burn in the Gulf of Mexico. A blowout occurred last night. All 44 workers were evacuated before the fire started. The owner of the well, Hercules, said that stopping the flow of natural gas could require drilling a relief well. Officials say the blowout is not expected to be as damaging as the BP oil spill 3 years ago.
Well, from one commodity to another, this one, coffee, Starbucks and Dunkin' Donuts both report their earnings tomorrow. The competition, of course, is fierce, and their results come at a time when the world is awash in a coffee glut. Jane Wells goes inside the Java Wars.
Tall, non-fat latte.
Americans take their cup of joe seriously.
I prefer Dunkin' Donuts because the price is reasonable and the taste of the coffee is great.
I don't like Dunkin' Donuts at all. I like Starbucks. It's a better coffee.
When it comes to coffee, there's usually no middle grounds.
Starbucks just tastes better. Starbucks is too expensive, and I can't pronounce anything on their menu.
The good news is that globally there is a glut of coffee. Goldman Sachs says inventories are at a 5-year high.
But while big picture, the world is swimming in Java, when you get to the little picture, it's not so good in a small state where coffee is a big deal.
Hawaii's Kona coffee industry is being destroyed by a small pest called the coffee berry borer, infesting as many as 80% of farms, and some are being abandoned. So the USDA is spending $1 million to try to fight the pest. Still, consumers should not see much impact in pricing, and a lot of attention is being paid to what's happening with coffee in the grocery store. Jeffries reports K-Cup sales are up 20% from a year ago as prices fall, and bagged coffee sales are seeing new, lower-priced competition.
A rich, never bitter taste, cup after cup.
Gevalia, owned by Kraft Foods, has seen grocery store sales more than double, according to Jeffries, perhaps helped by a sexy new ad campaign. But as all the major retailers report earnings this week, analysts say all of them will show double-digit earnings growth. Maybe when it comes to coffee wars, everybody wins.
All coffee is good coffee.
For Nightly Business Report, I'm Jane Wells.
All coffee, good coffee. Do you have a preference?
Well, I'm liking that Gevalia guy. That's pretty good.
Well, that's Nightly Business Report for us tonight. I'm Susie Garrett. Thanks so much for joining us.
And I'm Tyler Matheson. Have a great evening, everybody. We'll see you right back here tomorrow night.
Nightly Business Report has been brought to you by sailing through the heart of historic cities and landscapes on a river. You get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Susie Garrett with a Nightly Business Report news brief. Facebook investors are friending the stock tonight. The social networking company reported surprisingly strong quarterly profits and revenues, with the number of users and mobile ads soaring. Elsewhere on Wall Street, the Dow and S&P pulling back from record highs, dragged down by weak results from Dow component Caterpillar and AT&T. But a strong performance from Apple kept the Nasdaq in the black. The Dow lost 25 points, the Nasdaq added a fraction, while the S&P fell nearly 6.5 points. Michael Dell sweetened his buyout offer for Dell by 10 cents a share. Shareholders vote on the offer August 2nd. And in Detroit, a federal judge cleared the way for the bankruptcy case to go forward without legal challenges. Be sure to tune into Nightly Business Report right here on your public television station.